Hello, recent graduates. I know that you're preparing for the bar exam, and I'm sorry I can't be there in person today. I know, how important and how good these lectures are for preparing you for the bar exam, and I always try to be there in person, but it was impossible today, and so I am recording a lecture the evening before to show to you on Monday today from my sitting room, and you'll see some little ancient Greek here in the background. If you're really curious about it, I can ask me about it and I can tell you what it says. But we're not here to talk about ancient Greek law, but here to talk about the hardcore commercial law of secured transactions. So I'm going to go through my standard lecture, which will hopefully prepare you and make you feel at ease if you should come up against a secured transactions question on the bar exam, which is highly likely. It doesn't happen every time, but it seems very frequent, maybe at least 2/3 of the time. So it's important that you know this material and you're comfortable with it, and I'm going to help you out with understanding the structure of secured transactions and how to go about answering these questions. So let me just set it up this way. I think there are generally two flavors of secured transactions questions. The most typical one will be a question about a contest between two competing parties that are trying to get at the same assets. Right? Secured transactions is all about creditors or other parties trying to get at assets or keep assets of the debtor. We're all familiar with the basic nature of a secured transaction. We have an analogous type under property law mortgage, right? You take out a loan from a bank and then you pledge your house to them under a mortgage, so if you default in your loan obligations, the bank takes your house. That's real property law. That's not secured transactions, because there's this very clear divide in U.S. law between real property law and the law of mortgages and personal property law and the law of secured transactions, but at the core they're really the same thing. It's about pledging your assets to secure a loan. But secured transactions deals with Article 9, the UCC, and personal property, which is really anything other than real property, other than buildings and land. Personal property can be anything else. It can be goods, it can be monetary instruments, it can be cash, it can be deposit accounts, it can be stocks and bonds, it can be intellectual property, it can be anything other than real property. One type, as I was saying, the one type of secured transactions question will be a type of a contest between two competing parties that are trying to get at the same assets. And your job, when you're answering the question, will be to determine who wins, or in the parlance of Article 9 of the UCC, who has priority. So that's the most typical type of secured transaction question, and the one that I'll be spending the most time talking about during this talk. The other type of secured transaction question deals with the enforcement of a security interest. Not who wins, but how the winning party goes about enforcing the security interest. And I'll talk a little bit at the end about that type of question and how to deal with it. Okay, but let's deal with the most typical type of question. This is the way you should look at it. It's going to describe a fact pattern. It's going to describe two different parties trying to get at the same assets, and you need to figure out who wins. And so you have to be able to do a couple of things. You have to be able to first identify the two parties as they are treated under Article 9. You have to figure out whether they are a secured party. Do they have a security interest? If they are a secured party, are they a perfected secured party? Are they perhaps a purchase money secured party? Are they a buyer of the assets? Are they a buyer in the ordinary course of business, or are they a lien creditor? So these are all different types of of categories that you can place parties, these competing parties, into. And you have to be able to do that because that's critical. I mean, the type of party you are will determine whether you have priority or not. So you have to be able to identify the parties. You also have to be able to identify the types of collateral, because the types of collateral will affect the different types of rules that will apply. For example, if you're dealing with accounts receivable, which are known as accounts under Article 9, you can only perfect accounts receivable by filing a financing statement. And so you have to be able to identify, oh, those are accounts receivable, those are accounts. And so the only way that a party can be a perfected secured party is if they file the proper financing statement. Whereas other types of collateral can be perfected in other ways. Other types of collateral, such as goods, could be perfected by possession or a financing statement. Or a deposit account, which is what we call a bank account under Article 9. A deposit account can be perfected by getting control of the account. And so being able to identify the type of collateral is also important. So identifying the parties, identifying the collateral, and then you need to understand the priority rules. So those are the three basic things that we're going to go over. Identifying the parties, identifying the collateral, spend a little time on, and then the priority rules. I'm going to list a number of priority rules. And then, if you can apply those concepts to the question, and, write a few things on your essay that make it clear that you understand the parlance of Article 9 and the rules of Article 9, then you're going to do just fine. All right, so let's talk about parties, first of all. Parties. How do we identify the parties? Well, let me go through the different categories and talk a little bit more in depth about them. So first of all, you might have a party that really has no interest whatsoever, is not a secured party. You may think it's a secured party because they think that they entered into a proper security agreement. But in the analysis of the facts, you determine that the security agreement was not valid because, for example, as I'll discuss more a little later, the description of the collateral in the security agreement was super generic. It said, debtor hereby grants the secured party a security interest in all of debtor's property and assets. That's called a super generic description, right? All of their property, all of their assets, and no more specificity. And that is unacceptable in a security agreement, renders the security agreement invalid, which means that there is no security interest. So that's one type of party where there is no security interest. There's no interest at all. And in that case, that party is always going to lose because they have no interest whatsoever. So that's one type of party. All right, the next type of party is a secured party. It is a party that has a security interest because they've entered into a property security agreement. I'll explain that in a little more depth later. But we have a secured party. They've entered into a proper security agreement, which is all it takes to be a secured party. You could have a perfected secured party then versus an unperfected secured party. Merely entering into a security agreement that's proper will give you a security interest. That means the security interest has attached, and that's good to use that word in your answer. The security interest has attached. That means it's been created. But then you can perfect your security interest, and that gives you greater priority. And so you have to be able to determine whether you just have a secured party or whether you have a perfected secured party. And that requires you to be able to analyze whether or not the proper steps for perfection were carried out. Okay, and we'll talk about that a little bit later. So now I've talked about three different types of parties, right? The non-secured party, the one with no interest, the secured party, but unperfected, and then the secured party that's been perfected, a perfected security interest. Okay. Then there's yet another type of party. I think I'm going to go through 1, 2, 3, 4, 5, 6, 7 parties here. The next type is a purchase money secured party. And I'll run through that right now, and I'll probably hit it again during the course of this lecture. But it's important that you be able to recognize what a purchase money security interest is and what a purchase money secured party is, because that party will have special priority rights or super priority. And so you have to be able to identify in the fact pattern, hey, we're probably dealing with the purchase money security interest here. And what is that? There are two types. And this is really pretty easy, but you got to have it. You got to have it clear. You got to be able to pick this out of the fact pattern because it's easily tested. And if you can pick it up, you've got it made. And it's not that difficult. So here we go. A purchase money secured party can be a party that sells goods, and this only deals with goods, something to keep in mind. Purchase money secured party is only when you're dealing with goods, or software, but that's rarely dealt with in the bar exam. So we're talking about goods, right? Movable, tangible property, like this table that my iPad is sitting on, or that painting of ancient Greek poetry back there. Goods, movable property. Okay, so the purchase money secured party can be a party who sells goods on credit, so that the buyer has to pay installments every month, for example. So it's a seller of goods on credit who then takes a security interest in the very item that they sold. So I could be a furniture store, and I sell you this table on credit, so you have to pay me $100 a month because it's a pretty nice table. You got to pay me $100 a month for the next year. And then I take a security interest in the table, so that if you don't pay me your $100 a month, I get to send some guys to go and repossess your table. So I have a security interest in that table, but more than that, I have a purchase money security interest in that table because I sold it to you on credit. So someone that sells you something on credit takes a security interest in that very thing, boom, purchase money security party. Be able to recognize that fact pattern. The other type is called an enabling loan. The one I just described is called a purchase money security interest, purchase price, purchase money security interest. Now I'm going to describe what's called an enabling loan, purchase money security interest. And that is when a bank loans you money for the explicit purpose of buying something, such as this table, and then you buy the table and with the money that's been loaned to you, and the bank takes a security interest in that table, in that very thing that they loaned you money for. So you see, there has to be the intent that they loan the money for that purpose, you use that money for that purpose, and the bank takes a security interest in that item that you buy. That's pretty straightforward. But there you have another purchase money secured party. Okay, so understand those two types of purchase money secured party, the purchase price and the enabling loan. What's another type of party? The lien creditor. The lien creditor typically comes up. A lien creditor is not a secured party. It's a party that has an interest in the assets, but for other reasons. And will try to be getting at these assets, but for other reasons, not because they have a security interest. And what are those other reasons? Those other bases in law for this interest in the assets? Typically it's because a party has had a judgment rendered against them, or in their favor, against the debtor. So let's say someone has, accidentally ran over someone's bicycle with my car. They sue me, and they get a judgment. They say it wasn't accidental. They say it was negligent. They get a judgment against me. But I don't pay for whatever reason. Okay, so now they take that judgment and they convert it into a writ of execution, and they come after my assets with the sheriff, and they come after my table. They're a lien creditor. So they're a party that had a court judgment, they've converted it into a writ of execution, and now they come after my table. They're a lien creditor in the parlance of Article 9. They're treated as a lien creditor under Article 9. And how does this come together? And I'll show you how this starts to come together, is that that party, the owner of the bicycle that I ran over, might want this table. But the bank that loaned me the money to buy this table might want it as well. And maybe I defaulted on their loan. And then you have this contest emerging between the bank, this might be a purchase money secured party, versus this lien creditor. They both want this table, but only one of them will be able to get it at the end. And the question for you will be, who wins? This purchase money secured party or the lien creditor? And it'll probably be this purchase money secured party who defeats the lien creditor. So the lien creditor will typically be a party that has a judgment that's been converted into this right to seize assets. Another type of lien creditor is a trustee in bankruptcy. And you don't have to know bankruptcy law going into the bar exam, but you have to, because Article 9 deals with a trustee in bankruptcy under state law. You should know this. And that is when a person or an entity goes bankrupt, a trustee in bankruptcy is appointed to oversee all of their assets and to place what is called a stay over all of their assets, which stops all actions against the assets, so that the trustee in bankruptcy can kind of control, everything. And let's say I went bankrupt, a trustee in bankruptcy would come in and kind of control all of the assets in my house, this chair I'm sitting in, the table, the Greek art, and stop every action against it and just say, no one can seize anything, hold on, everyone catch their breath, there's a stay on every action. And that's what the trustee in bankruptcy can do. And the question is, all right, so you can view the trustee in bankruptcy, which is a lien creditor under Article 9, as having some kind of claim or control over this property that's subject to the bankruptcy. And so you look at that trustee in bankruptcy, or the lien creditor, as one competing claimant. All right, they're trying to control what's happening to these assets by stopping all actions against them. But then there will be other parties. There might be lien creditors trying to come after this table or that art, that wonderful art. Or there might be a secured party coming after the assets in this house. And so the question is, who wins? And as we'll see, a secured party that has a perfected security interest, and I'll repeat this again, a secured party that has a perfected security interest will be able to get at this table, or whatever it has a perfected security interest in, and defeat the trustee in bankruptcy. That is, will be able to overcome that stay and reach into this shielded bankruptcy estate and get at those assets. So that's another kind of lien creditor, is the trustee in bankruptcy. Just know that, and then you apply the proper priority rules. So the judgment creditor, the trustee in bankruptcy, lien creditors, and you'll apply the appropriate lien creditor priority rules when the time comes. All right, now I'm going to talk about two other types of parties in a secured transaction scenario, and that is buyers. Two types of buyers. An ordinary buyer, I'll just call a buyer. And how does this come up? Well, let me mention the other type, is a buyer in the ordinary course of business. Those are two types of buyers. You need to be able to identify and apply the appropriate priority rule. So you have to be able to distinguish a buyer is really the challenge, to distinguish a buyer from a buyer in the ordinary course of business. And let me paint a broader picture for you. How does a buyer come into this scenario? Well, let's say a company takes out a $100,000 loan from a bank to buy equipment for its factory. And it buys a lathe and a drill press, other types of equipment. It's a machine shop. Okay, and the bank takes a security interest in those items. So the bank is a secured party, or probably a purchase money secured party, right? Because gave money for this equipment and takes a security interest in this specific equipment. But then the company, the debtor, is having some tough financial times and needs to meet payroll. And so it takes the lathe and it sells it to another machine shop for $2,000. Now that other machine shop that just bought it, that's the buyer. And now let's say that original company that took out the loan goes bankrupt, and the bank wants to assert its security interest against that lathe, but the buyer wants to keep it because it paid good money for that lathe. And so a contest emerges between the bank, who's a secured party, and the buyer, who wants to keep the lathe. A contest. And you got to know the priority rule that applies when you're dealing with a secured party versus a buyer. Who wins? And we'll get to that. So that's one type of scenario, when you have an ordinary buyer like that. A buyer in the ordinary course of business is a little different. And you got to be able to identify it right off the bat. You don't want to waste any time wondering whether it's a buyer in the ordinary course of business or not. Should be pretty clear, or you should be familiar with this concept. And the way I like to describe it is you and me going into Walmart. I don't shop really at Walmart, but I don't know, that's what comes to mind. You walk into Walmart and you buy a lawnmower. I'm sure they sell lawnmowers. You buy a lawnmower, you're a buyer in the ordinary course of business. Right? And what is the difference between the scenario I just described and going into Walmart and buying a lawnmower? And this is the definition of being a buyer in the ordinary course of business. It's a bit of a mouthful. But it's when you buy goods from a seller who's in the business of selling goods of that kind. I'll say it again. When you're a buyer who buys goods from a seller who's in the business of selling goods of that kind. And Walmart is in the business of selling lawnmowers. Or you go in there and you buy 20 footballs for your football team. They're in the business of selling footballs. That's what they do. And you're a buyer in the ordinary course of business, or a biocob in short. That's different from the scenario that I described earlier, where the machine shop bought the lathe from the other machine shop. That machine shop that sold the lathe, they're not in the business of selling lathes. That's not what they do. They use the lathe to make little parts and sell those parts. They're not in the business of selling lathes. That's just kind of a one-off deal that they make to sell some used equipment to another buyer. So that's the difference. When you buy, basically it's going to be a retail situation. When you go in and buy from a retail, it could be a wholesale situation, but it's whenever you go in and buy goods from someone who's in the business of selling goods of that type. And it doesn't have to be a consumer like you and me going into Walmart. It can be a company that goes to a wholesale manufacturer that sells lathes, for example. This isn't Walmart. You're going to the manufacturer that builds lathes or builds drill presses, and you're a company and you go to them and you're buying a drill press. You're a buyer in the ordinary course of business because you're buying something from someone who makes their living selling that thing that you bought. Okay? That's a buyer in the ordinary course of business. So that's the last party that I'm going to describe to you. We're going to move on to the next phase of this. We're 23 minutes in, so I'm going to keep it going, but it's important that you be able to distinguish those different parties. Now we're going to move into the next phase of this talk, and it's important that you be able to distinguish the different types of collateral, because the rules can change, and they do change, depending on the types of collateral that you're dealing with. So you got to be able to, you got to be able to know what goods are. That's one type of collateral. Those are movable, tangible objects. Like my phone, my eyeglasses, this pencil, this desk, the art. I've got a fishbowl here. I won't show you. But it can be tables, desks, chairs. It can be that lathe or that drill press. It can be big things. Goods are divided into different categories, and you got to know those categories as well. They're divided into inventory, which is goods that are held for sale or lease. You know what inventory are. It's all the things that Walmart has on their shelves. So inventory is one type of goods, subset of goods. Equipment is a catch-all type. It is anything that isn't inventory, aren't farm products, and aren't consumer goods. And it's less likely that you'll be dealing with farm products in the bar exam. You may deal with consumer goods, which are items that are bought, goods that are bought for personal household use. So you got to be able to distinguish between farm products, which are items used on a farm, consumer products, which are goods bought for personal consumer use, for personal household use, inventory, which are goods bought for sale or lease, and then equipment is the catch-all, is everything that's not a good that falls under those other categories. And that's typically like anything else that you go into a business, you go into a factory, they don't have any inventory on hand, or maybe they have some inventory. Okay, let's say they have some inventory on hand, the manufactured products which they're going to sell. Then they have all this other stuff in their factory space, right? They have tables, desks, chairs, computers. They have the lathe, they have the drill press, they have raw materials like steel, ingots, and that's all equipment. So that's a catch-all category. Other types of collateral, I can't teach them all to you in detail, but you're going to have to spend some time, make sure you're familiar, be able to identify different types of collateral to a significant extent. Instruments, those are promissory notes or checks. Right? A promissory note, it's a promise to pay someone a certain amount of money. Accounts, those are accounts receivable, right? You sell someone something, a business sells someone a computer on credit, and that buyer has to pay installments every month. That's an account receivable in ordinary parlance, but in Article 9 that's called an account. And that's a valuable piece of property, that right to collect that stream of income. That's an account. And a company will take those accounts, that right to collect money on a monthly basis from customers, and will use them as collateral to take loans from banks, so that if they take the loan and then they don't pay back the loan on time, the bank will enforce a security interest against those accounts receivable, and begin to collect the money directly from the customers, so that the seller won't get that money anymore, the bank will get that money. So accounts is another type of collateral. Deposit accounts is another type of collateral, quite distinct from accounts. Accounts are accounts receivable. Deposit accounts are bank accounts, what we would call bank accounts. That's another type of collateral, and it can be used by companies also as collateral. So if you default on your loan obligation, the bank will seize your bank accounts. Money is another type of distinct collateral. That is cash money. And it's treated distinctly in that, and I'll just give you this as a little tip to put in your hat, and that is, money can only be perfected by possession. You can never perfect money, cash, by filing a financing statement. Okay, accounts, this is another little tip, and maybe I'll repeat it, can only be perfected by filing a financing statement. You can't perfect accounts by taking possession of the sales agreements. Chattel paper is another type of collateral. That is an account that's coupled with a security interest. So let's say I sell a car to a customer. I'm a car dealership. I sell a car, take a security interest in that car, sell it on credit, and then I have this agreement with the buyer that says, you're going to pay me $1,000 a month for the next 3 years, and I have a security interest in your car, and if you default, I will repossess your car. That is chattel paper. It's more than an account. An account is just a sales agreement that you're going to pay in installments, but this has a security interest coupled with it, and that is called chattel paper. And that makes a difference, because chattel paper can be perfected by possession, by holding on to that contract, whereas a mere account without the security interest cannot be perfected by possession. If they test you on that, you will nail it. You got to know these rules. Okay, there are other types of collateral. I won't go through them all. You know, there are payment intangibles, there are general intangibles, there's software. There are different types, but you know, I've gone through, I think, some of the main types. All right, now what we're going to hit, we're at the halfway mark here.